from Utah, Ms. Love.
Thank you, Mr. Chairman. Thank you, Chair Yellen, for being here today. Chair Yellen, I'm increasingly concerned about the impact of Dodd-Frank regulations on real economy, economic growth, and especially job creation, which I'd like to just ask you a few questions about. If you look beyond the headlines, the headline numbers from last Friday's job numbers and include discouraged workers and the underemployment, real unemployment remains high, nearly 10%. In addition, millions of people have stopped looking for jobs. They have dropped out of the workforce, and it's a dynamic that is driving the nation's workforce participation rate to an all-time low at 62.7%. And I want you to know that I agree with my colleague on the other side of the aisle, Representative Scott, when he talks about the large number of unemployment with our young Black Americans. Meanwhile, economic growth slowed to just 0.7% in the fourth quarter. I'm concerned that the Fed and other financial regulators may not have a firm grip on the cumulative impact on the real economy of thousands of pages of the new Dodd-Frank regulations, especially new capital and liquidity rules. I'm wondering if you share some of those concerns.
Well, I recognize that some of the new concerns are burdensome and do raise banks' cost of financial intermediation. In designing those regulations, we're always trying to achieve a balance between the benefits of creating a sounder and more resilient financial system that is less likely to be subject to the kind of devastating financial crisis that we had. We're balancing that against burdens that can raise the cost of capital or diminish financial intermediation. And we have tried to strike a reasonable balance, remembering that the financial crisis, nothing resulted in more harm for a longer period of time than the financial crisis that we lived through. And I think we now have a much safer and sounder financial system.
Okay, so another study by the American Action Forum found that consumer credit availability deteriorated 12 to 14% since the passage of Dodd-Frank. I'm also concerned that the growing number of borrowers unable to access affordable bank financing, a lot of borrowers from districts, low-income areas in my district, Kearns, West Valley. These are hardworking Americans that are turning to high-cost and unregulated online lenders to be able to get the access to the credit that they need, whether it's purchasing a car or even starting a small business. They're finding that their ability to access this type of credit is unavailable to them. And so I'm wondering if you also share some of my concerns about credit availability and the higher cost alternatives.
Well, I do share your concerns about credit availability, and I think it's clear that credit availability has, in particular segments, been diminished. Home loans, mortgages, for example, for individuals without pristine credit ratings is really difficult, remains difficult to obtain. In part, we have regulations that are meant to address harms. I think lending standards were too easy prior to the financial crisis. We don't want to go back to lending standards that are so loose that they lead to the kinds of predatory lending and harms that we had that took a toll on the economy and on low-income households and communities. We need to achieve a reasonable balance, and we're searching for that.
Being on the subcommittee of monetary policy, I wanted to ask you just a quick question on monetary policy and what's happening in Europe, and what are the implications? I may have stepped out of the room. I don't know if you've addressed this, but very quickly, implications of European financial instability on the American financial system. What are the implications of the Federal Reserve and the ECB pursuing divergent monetary policies?
Well, the ECB has been addressing high unemployment and inflation that slipped very meaningfully below their 2% goal by putting in place negative interest rates and large-scale asset purchase programs. The U.S. has done better. We're among advanced economies about the strongest, so we have divergent monetary policies. It's put upward pressure on the dollar over a long period of time, which has harmed manufacturing and net exports. And so it has resulted in negative influences on a part of our economy.
Time of the gentlelady.